Welcome everybody to Klaas Financial's first quarter of 2021 webinar. Thank you for joining us. My name is CJ Klaas. I'm the President and CFO here at Klaas Financial, and to my right is Todd Eklund. He's the Director of our Portfolio Management team. Todd and I have been doing these webinars now for the last about year, and this has been a little bit of a change. Many of you know we used to do a conference call. But some of our clients said, we'd rather see you and have it be a little more interactive. So hopefully you all have enjoyed this. Our intent is to continue doing it. Todd and I represent a cross-discipline within the organization. Todd is the director of our portfolio management team. He handles the actual trading, investment allocation, and portfolio construction of the various accounts that many of you have with us. My job is, as one of the advisors of the organization, one of the executives, to kind of keep an eye on what's happening with our clients and what they're thinking, what they're saying. And between the two of us, it kind of represents a nice cross-discipline that we're going to bring here to you today and talk a little bit about. A few housekeeping items. First, this is being recorded right now. When we're done with this, we will post it to our website under I think it's our resources tab under the quarterly webinar. That should come out probably within the next week or so. So if you miss anything or want to listen to it again or forward it on to a friend, you can look there. The next thing is that we expect the presentation part of this meeting to last about 20 to 30 minutes. And then after that, we will have a Q&A session. It's actually a good reminder. At the bottom of your screens, you will see a little Q&A button. That is where you can go ahead and start building a list of your questions. If you are coming into this meeting with a question today, we would encourage you to go ahead and type that in now. It actually will not interrupt the meeting at all. Or if, as we're going through the content, there's something that perks your interest or you have a question about, go ahead and just type it in on the fly. The next thing that we wanted to mention to you as a housekeeping item is just what is the purpose of these meetings? Often people have said to us, are you trying to predict what's happening in the market or what's about to come? What is the intent here? And so I wanted to make sure that you understand really our intent is to educate our clients about what we see happening in the stock market, the economy, and any policy changes that are happening that may impact you or your portfolios. Listen, what we don't want to be is we don't want to be the place that you come to and it sounds like everything else where you're hearing maybe fear-mongering or polarization about what's happening in politics. What we really want out of this is for this to be a place where you can start to separate fact from fear. So hopefully this is marked by more education than anything that you're hearing being sold to you or any fear that would spike out of it. All right, as we move into our slides today, I want to just remind you of who Klaas Financial is and what it is that we do. So on your screen, you're going to see here in front of you, basically a few different by the numbers factors about Klaas Financial. So we were actually founded on the far left there back in 1976. So we've been in business about 45 years. We have just over 1,000 household clients that we work with. We have 20 total employees across 2 different locations, one here in Madison, Wisconsin, another in Loves Park, Illinois. We directly manage about 625 million of client assets, and then we operate in 28 states. As you can imagine, Illinois and Wisconsin are not the most popular states to retire to, and so people tend to move out of these states at times, and we continue to work with them across the United States. But at the end of the day, what we really do is we help individuals and businesses both plan and invest for retirement. So that is one of basically our core mission statement and what we exist to do. As we transition into the meat of our discussion today, we wanted to begin by reminding everyone that March and April marks the 1-year unhappy anniversary of when COVID hit the shores of the United States. What you are seeing on your screens here is a graph showing you basically from the beginning of 2020, so beginning of last year, rolling into March and April when COVID was hitting the shores of the United States. And we are cross-sectioning TSA checkpoint travelers in millions against what was happening with the S&P 500 index as basically people stopped traveling. Now, only nerds like Todd and his PMG team are the ones that can actually pull together these types of cross-sectional data. And please do not trade on this kind of data, because a lot of you are thinking, ooh, maybe this is a signal of the market. It's not what we're trying to do, but rather it is fascinating, isn't it? You can see that TSA checkpoints came plummeting down, of course, as people stopped traveling, as the shutdowns occurred, and simultaneously to that, the stock market, as defined by the S&P 500, went through a huge collapse. Now listen, I don't know if you remember that time like I do, but it's seared in my brain, and I know it is in Todd's as well. This was a scary time. If you think back to what was happening at that time, you would go to the grocery store and you'd see hardly anybody. If you went out and drove out on the roads, there was almost nobody around. It was almost eerie. And so to fast forward to where we are today, I don't know how all of you feel, but I feel somewhat blessed to be sitting here today with the market having gone through one of its fastest declines we had ever seen back in March of last year, to now be at a place where, believe it or not, we've had a vaccine that was created in record time. And we now have upwards of 100 million Americans that have been vaccinated against COVID-19. Who would have dreamt that we would be here? As a matter of fact, Todd and I were both able to be vaccinated.
No masks.
Which is one of the reasons why we are not wearing masks today. We're both a couple weeks out from our vaccination. So what a blessing to be sitting where we are today. Would have never dreamt it about a year ago. So at this point, I'm going to turn over the next few slides to Todd.
Thanks, CJ. Yeah, if we move ahead, what a round trip journey it has been, really. And looking at the stock market, you wouldn't have guessed that a year later, we'd be so far above the pre-pandemic high. But again, the economy and business revenues have not rebounded that fast. And so we've talked about this in past webinars that it's been an uneven recovery for the economy versus financial assets. And a big part of this has been attributed to the booster shot policy response that we got, both from the federal government and the Federal Reserve, slashing interest rates last year as the pandemic hit. You had the stimulus checks, the PPP loans. It was a much more coordinated and rapid policy response than happened in, say, the 2008 recession, for instance. So that's been a big part of the rebound in the stock market. But if we move to the next slide, we've got to give some credit to policymakers for keeping things from falling apart. But I think we really also have to give credit to society at large and ourselves for adapting to the pandemic. We've taken on new technology, new habits and routines. And for all the things that declined and contracted over the year with the pandemic, you really have to marvel in the growth of things like video conferencing, grocery shopping apps, at-home fitness apps, online payments. We've really had 10 years of digital transformation in 10 months' time, and it's impressive to see. And there's a lot of businesses out there that are going to emerge from the pandemic stronger than before. So if we move ahead, there's a lot of bright spots, right? I think a year ago today, we never would have guessed that we'd be at this point, both on the mend in the economy and getting vaccinated and healthy again, right, this soon. But it's worth noting that it's still been a very deep and severe recession. If we look at the labor markets and unemployment, we're still above what would be considered a normal level for a non-recessionary period. So things have been getting better, but it's still on the mend. And it's been, it might not feel like it every day, but it has been one of the worst economic shocks and declines ever in the history of this country. And so while some areas have been virtually unaffected, I don't think we really shut down one day here at Klaas Financial, but other areas like dining, travel, and entertainment are still waiting to recover. So if we move ahead to the next slide, one of the things that's happened as the economy has rebounded to start the year has been a strong rise in bond yields and interest rates. And this can actually be seen as a good thing. It's sort of forecasting the market's interpretation of the recovery. The 10-year Treasury bond yield, which we're looking at here on the screen right now, more than doubled during the first 3 months of 2021. So if you think back to the spring of last year, interest rates were cut by the Federal Reserve, and they declined to a level that I never thought, although I've said this numerous times throughout my career, I never thought we'd see interest rates that low, all the way at 0.5%. So we've had this rebounding off the floor in interest rates. And what that's forecasting is better growth, higher inflation, moving policy from crisis policy to normalizing policy. And so that can be a good thing. Unfortunately, what it means for investors, if we look ahead and starting the year, is that we've had negative bond returns. That's not something that a lot of us are used to seeing all that often. So we to start the year, bond returns really across the board have been negative due to the increase in yields. And for those of you who they're unfamiliar, you haven't opened sort of a finance textbook in a while, there's an inverse relationship between bond prices and bond yields. So as yields move higher, prices of bonds generally move lower and vice versa. And it's going to be more pronounced, the decline, for bonds that are of longer maturity, say 10 years out in the future, versus bonds that are only a few years out, 1-2 years away from maturity, as you can see here on the graph in front of you. So, again, bonds are those safe, stable assets. We're used to seeing them as being steady and reliable. They don't return as much as stocks in your portfolio, but it's something that we rarely, tend to see declined. And if we move ahead to the next slide, there's not very many full calendar years in history when bond returns are negative. It doesn't never happen, but most of the time we're not experiencing it. And the other thing that I would add is we're looking at here that most of the time when you have a year when bond returns are negative, it has tended to be, at least looking back over the past 30 years, accompanied by strong gains in the stock market. So as you can see in 1999 and 2013, you had softer bond returns, but also big gains in the stock market. The exception to that was 1994. And I do want to highlight that. Now, what you had in 1994 was a economy that was not bad, but not great. The Clinton had just taken office, and the economy had not really taken off yet. And the markets at that time expected that policymakers of the Federal Reserve would do everything they can to spark the economy and keep it going and not worry about inflation at all. And what happened is that the exact opposite unfolded. Inflation started to tick up, and price levels, increasing and expanding, still with a slow economy. And the Federal Reserve raised interest rates and hiked them up really rapidly in a short period of time to stave off that inflation. And it kind of caught the markets by surprise. So you had a year where bond returns were negative, and you had essentially a flat stock market. Now, I don't know what the rest of this year is going to unfold. I would say this, that in my opinion, I think the likelihood of a scenario like 1994 happening to us today is fairly low. And I say that because policymakers have made it very, very clear and been pretty transparent that their number one goal is to keep the economy moving and back towards recovery. And inflation is really pretty low on the totem pole of their list of concerns today. But I do highlight that in terms of an example that sometimes things happen that are totally different from what we all expect and the markets expect. And that's when you can be surprised with these types of situations.
Yeah, absolutely. Well, and I want to, just reemphasize before I get into taxes and budget deficits here, what Todd is referencing as it relates to rising interest rates. What that means for each of you sitting on the call here who has a portfolio with us is gone are the days of being able to sit in a bond fund and see 8, 9, 10% rates of return, because as interest rates decline, the value of a bond goes up. Right. Well, now we're in the opposite. Interest rates are rising. The value of existing bonds are going down. This can often be a little bit confusing because people go, no. I just bought a new CD and rates ticked up. Right. So there is a difference between existing bonds or existing CDs versus new CDs. So certainly as interest rates tick up, you are actually able to buy fixed income instruments and get a higher rate of return, but only new instruments. The existing ones that are out in the marketplace get repriced down typically. It's called marking a bond to the market. If you want to look it up on Google later on, you can. But the long story short is it's going to be harder to get a positive return now out of your fixed income like you have been for the past really 35 years. And therefore, it's going to require a little bit more risk taking for people to actually get good, consistent, positive rates of return going forward. Now, truth be told, Todd and I study the markets and have for a long time. And so this is what we would call more of a normal environment. We just haven't had a normalized environment like this for 35 years because we've had interest rates declining for so long. But of course, what is on everybody's mind is taxes and
Especially
debt.
today, right?
Especially today. I don't know if anybody saw the headlines, but kind of towards the middle of the day, the market dropped a little bit as it was hearing first news about some potential tax hikes. But what you see on your screen here from left to right is from 1966 to the year 2018. The top, that blue line from left to right is the top marginal income tax bracket in the United States. So you can see back in 1966, the top bracket was almost 80%. But you can see that marginal income taxes have been coming down over time. But you can also see it overlaid with the gray section, which is debt to GDP ratios in the United States, which has been increasing over time. So simultaneously, taxes are going down while the amount of government debt is going up. I think this is on the minds of a lot of you. Now, maybe you haven't thought of it in the terms you're seeing here on the screen, but it sticks out like a sore thumb, doesn't it? Which is that we are now, and by the way, this is only through 2018. If we were to actually update this until 2021 with the $5 trillion that has been spent recently, we're upwards of 120% debt to GDP here in the United States right now. This problem is only getting greater. We're not here to get political about the topic in terms of how do you solve it. However, most people know at a very macro level, this gets solved in one of two ways: higher taxes or lower spending, which comes in the form of less social programs, lower social programs, cut programs, whatever it might be. So you either gotta tax your way out or cut your way out, as you've heard people say, or some combination thereof. We're not here to say what is right or wrong, but rather to acknowledge and point out the gap that is in existence right now that is gonna have to be addressed and overcome by future policymakers. Now, before we move on from this slide, I do want to mention to you all that there is a difference between the stock market and the economy. One mistake we will occasionally hear people bring up to us is they will say, well, the stock market must be getting pummeled because the US government has so much debt. And I want to remind you, the US stock market, the US government does not trade on the New York Stock Exchange, right? US corporations trade on the New York Stock Exchange. And therefore, you can have an unhealthy government while you actually have healthy corporations with even healthy balance sheets. And that is somewhat of what we're seeing right now here in the United States. You have corporations that have pivoted in the middle of a global pandemic, as Todd showed you, to make incredible solutions in the midst of a crisis that have really clean balance sheets and rising profits in the midst of a federal government that has a lot of debt. So I do want to remind you, while this needs to be addressed, you actually can still get markets growing while policymakers have to clean up their own balance sheets.
As we've shown this before, it's something that can't last this way forever, though.
Correct. It's got to be changed. Exactly right. So moving on to our next slide, I just want to remind you all what it is that we do to address these topics in the background. Because as you can imagine, as we talk about these things and bring up how policymakers may need to address taxes or debt, or when we talk about changes in pricing of the stock market, often what people will say is, how does this help me? And that's a great question. Ultimately, what we have here on the screen is just a sampling. Many of you have actually seen this particular report as we have met with you individually as advisors. But this is just a reminder that we can actually run scenarios forward. So we do not sit idle. We don't just watch what happens, what plays out in the economy and with policymakers and say, well, I hope you can afford it. No. We are proactive. We can run overlapping scenarios around what if this or what if that? What if Social Security declines? What if tax rates hike? What if we need to spend more? Or what if we need more income in retirement? What if we live to age 100? All of those different what if scenarios are real life, real world applications that can have significant impacts on your ability to remain retired, or at least retired successfully. And that is what we do. It's the cross section between changes in the market and policymakers with how that impacts your lives that we can actually run reports on and come up with meaningful solutions or meaningful data sets that can give you comfort. I will let you know, we have this core belief here in our organization, which is a lack of knowledge drives fear. Rather, an engagement or the presence of knowledge may not change your future, but it will at least give you a roadmap of what you can expect. And so our job is to make sure that you have clear expectations of what your future might look like based upon using technology tools like what you see in front of you. Unfortunately, we can't create guarantees. Todd and I laugh about this every once in a while. Some people will say, well, by doing planning, I'm eliminating all uncertainty. And unfortunately, that's just not the case. Planning does not eliminate uncertainty, but rather it accounts for it.
Well, and I think, as you said at the outset with our mission with these webinars, that we want to be the arbiters of truth and understanding of what it really is, and not just fear and poor decisions that can arise from hysteria at times.
Yeah, absolutely. Absolutely. So just the reminder is that we do rigorous data-driven dynamic reporting on these topics. So if any of you are in a future meeting and you want to take a look at any potential kind of policy situations that might pop up, by all means, let us know. But with that being said, at this point, we are through the core part of our presentation. We are now going to open it up to our Q&A. So at this point, Todd and I will pause for a moment. We're going to let the Q&A kind of roster fill up.
Okay.
At the bottom of your screen, there's a little Q&A button. Please click on that and start typing in your questions. And in a moment here, we'll jump on.
So we'll start with a simpler one of the two that have filtered in.
Okay.
I saw some recent trading activity in my account, selling stocks and buying bonds. Bonds have been going down. Can you tell me what this was for? Well, that's a good question. Very prescient. We recently, across a lot of our accounts, not all, because it is unique to your account, but if you think about what happened year over year, you had, I don't know the exact numbers of it, but I want to say global stocks from March of last year to now were up like 62%.
Yeah.
And as we talked about earlier, bonds have been fairly flat to negative. So we have been doing recently quite a bit of rebalancing in our clients' accounts, particularly accounts that are tax qualified, where there's no consequence, from a tax liability standpoint. So many of you in your retirement accounts probably saw that activity if it was needed, where your stocks had grown proportionally. We basically bring it back to target. Not because we're making any forecast about what's going to be better, but simply because it's grown so far that it's gotten out of whack. We're going to bring that back to target and make sure that you bank some of those gains that we've had over the past year.
Yeah, I'll emphasize what Todd is saying in that what we do is, well, what Todd and his team does is they build out globally diversified portfolios, and then they're very disciplined in their rebalancing behaviors. So they have what are called tolerance bands on these portfolios inside of specific securities and overall asset classes. And then when it reaches kind of a tolerance band, under most circumstances, we need to rebalance that portfolio to bring it back into its original design. And so that's some of the trades that you saw. When you get significant volatility in the market like we had last March, you're going to find that some asset classes do well, some don't do so well, and you start hitting those tolerance bands, at which point we need to rebalance. But Todd, I do think this is a good reminder for everybody. We do not build a single portfolio and then put everybody into that single portfolio, also known as, what is that, absolute return portfolios?
Sure.
Instead, we build portfolios across a spectrum from conservative, moderate to aggressive. And then we place people in those portfolios based upon their risk tolerance, age, different factors. So that's a good reminder for all of you that these rebalances that occur can be different based upon the different portfolio that you are in.
And you bring up a good point that generally the more conservative and mid-range of the spectrum is what needed rebalancing as compared to somebody who might be much younger and has 80% in stocks.
Exactly. Yeah. So what's our next question?
Let's go with the trickier one, I think, on the screen. And if I could paraphrase it, perhaps. What is our sense on where the market is heading? There's been a lot of media coverage indicating that we could be in a market bubble. would you guide clients to shift their profile to guard against a downturn? I'll let you start with that.
Yeah, great question.
Break it up. Are we in a bubble, and should people be doing anything?
Yeah. So there's a lot of different ways we could answer this, but I'll do my best here. Are we in a bubble? Let's begin with that. We would generally say no to that question, except that things can look like bubbles when you have shocks in the economy. So if interest rates were to spike, which we don't believe will happen, I don't think the Federal Reserve will allow that to occur, that could send a shock where stocks would need to reprice, which could feel like a bubble, although that's not a bubble bursting, by the way. Some people think it is, but that's not what it is. But no, we don't look at the stock market and say, wow, it's majorly overly inflated. Although most of you should know stocks are trading at a pretty high multiple of their earnings. This is known as a price to earnings ratio, and they are trading high, but often you'll hear that in what we call a vacuum. Whereas if you actually look at that relative to interest rates, because you all should know low interest rates actually allow for higher multiples on the overall stock market. And therefore, yes, it is trading at a historically high multiple, but we're also trading at historically low interest rates. So in general, we do not look at the economy and say there's a huge bubble. However, the bigger question, I don't know who this individual is, they're listed as anonymous, but the bigger question that you should be asking is, where are you in your life, right? Because that can have significant ramifications. Sometimes something has happened where maybe there's a death in the family and suddenly your finances change, or a child has come back to live at home with you. There can be real world, real life applications where you should shift your asset allocation. And that wouldn't be driven necessarily by where the market is, but rather by maybe your goals or objectives have changed.
Sure. I would just say this, that it's hard to predict, right, at any given time. Are we in a bubble? Right. Look, you can always look for the signs on the wall. I know that earlier this quarter, you had the GameStop thing. Right. I think Bitcoin is up 100% year to date. So you can look around and say, oh boy, it's got to be a bubble. But you hit on it well, CJ, that yes, stock prices are higher, the multiples are higher. Usually what that portends is just not that there's a crisis around the corner, but often can indicate that, well, your future returns will be perhaps lower.
That's true.
Right? To level set your expectations. The other thing I would add is part of the question we got was, well, should I do anything to protect against it? In my experience, it is very costly to take the view of the world's coming to an end, and let me try and find shelter from the 100-year flood that could be right around the corner. It is so hard to predict these things, and today the opportunity cost of sitting on the sideline, I mean, especially for someone who is either at or nearing retirement and beginning to take income, to just stay on the sidelines in safety or in a shelter waiting for that flood to come, well, there is a big consequence if it doesn't come.
Yep.
And so,
well, and I think Todd's spot on, and I want to emphasize, we don't like that any more than you do. Meaning I wish nothing more than to be able to say inflation's at 1% and I've got this nice guaranteed investment that gives you 8. That would make our lives a heck of a lot simpler. So we don't like it, but Todd is absolutely correct. The thought that you can jump on and off the ship, we actually reference this as a light switch. We call the light switches off and on. Our human nature wants to drive us towards on and off behavior.
Should I be in the market?
That's right. Should I be in the market or out of the market? And truth be told, the answer is most of the time, neither. You should have some blend of in the market and out of the market at all times. Great question.
Yes. Yeah. So here's a good one on bonds. Do we have recommendations for average maturity ranges for bond funds, or what type of maturity? So it's kind of a complicated question. I'll try my best. It kind of depends, and I'll try and put it in the context of your portfolios. Some types of bonds, a perfect example would be like a 30-year treasury bond. Yeah, we showed some returns earlier of what different bonds along the maturity spectrum. I think it went out to 10 years and it was down negative 4.4. Yeah. Like a 30-year treasury, which is the longest term bond you can find, is down like 15% year to date. I mean, it's absolutely just taken a huge hit. And people would look at that and see that it's in their portfolios and say, well, why would you own that if interest rates are rising? And the truth is that you actually do benefit if you have a longer term profile and you're going to be in the stock market with a portion of it. We actually do own some of those longer term treasury bonds as a complement, because oftentimes what happens is when you have a bear market, interest rates decline and those 30-year bonds go up a lot in value. So they act as a ballast and a buffer. One of the things that I'd say in my profession of investment professionals that for a decade they generally got wrong, and myself included, was that everybody thought interest rates can only go up, right? They hit this rock bottom and, oh boy, it's just going to be the opposite of the last 30 years. And it kind of never really happened. And so I would say that owning bonds in your typical range of what the index is, which is typically 6-7 years maturity, is that what you have to do to get some yield? And I would not advocate looking at it in the context of I'm only going to own the most safe 1 or 2 or 3 year out bonds because I think this is going to continue. It's very hard to predict.
Yes.
What would you say?
I would completely agree with Todd, and I would just simply add to that. For the last 12 years, if everybody remembers 13 years, 2008, 2009 is when the Federal Reserve started cutting interest rates due to the financial crisis, subprime lending crisis. As that occurred, since interest rates bottomed out in 2009, there has been predictions by all the professionals for literally the last 12 to 13 years that we would have rampant inflation. As a matter of fact, for those of you who are on with us, I can't see you, but raise your hand if that was one of you, because I'll bet almost all of you.
I thought it at one point.
At one point, we all said, oh, when you print this kind of money, remember quantitative easing, and now we've got, these different acts that are coming out, these different stimulus bills. Everybody keeps saying that there's going to be rampant inflation, but I can just tell you, if you shorten the duration of your fixed income 13 years ago, you have been pummeled as compared to an investor that just left it alone.
Or just did kind of what the market average
6-7 years. So what we would say is be ever so cautious. You need to be mindful of it, but we would say be cautious of in fixed income doing the light switch on and off.
Yes,
right? Going to the 30-year bond when you think interest rates are high, and to the 1-year bond when you think they're low. There's general wisdom even in your fixed income and being diversified across
spreading it out across the spectrum.
Yeah.
So, okay, we've got a question perfect with the tax rates today. So, with the expectations of higher tax rates coming in the future, is there a strategy for pulling money out of accounts like 401ks in order to take advantage of lower tax rates now versus waiting and taking out money when tax rates are higher in the coming years? Maybe you reframe and simplify that before answering.
Yes. So expecting higher tax rates. So first things first, I think we have to make sure we separate facts from fear. So to be aware of what the the administration, Biden-Harris administration, have actually kind of put pen to paper on. And from what I understand is there's been clear dialogue thus far about raising the marginal income tax rates for people earning over $400,000 in any year. There's been clear discussion around capital gains tax rates changes, specifically as of today. There's been some discussion around changing the federal estate tax limitation, and finally, corporate tax rates moving from 20 up to 28%. So you do want to be careful moving towards just significant changes without some sort of rational reason to move towards it. But within that context, if one of those contexts were to impact you, the answer would be a resounding yes to that question. Should you move towards taking advantage of the lower existing marginal income tax rates right now? And these are things like Roth conversions. That's a big strategy that we take a look at. These could be things like taking on capital gain inside of say a highly appreciated stock while you've got a lower long-term capital gains tax rates. These would be things that are absolutely key questions that we look to address and try to answer on an individual level when we meet with our clients.
And so much of it is unique to each person, is the truth.
Absolutely.
It really is. Yeah. For somebody who's in retirement, what is the likelihood that you're going to cross over this level of income threshold for a change? It's probably fairly low in many cases.
Yep.
So yeah, it is unique to each person, but I think knowing that changes somewhere and somehow are coming is a safe assumption.
Yes.
But as we've kind of said at the outset, not to think it's going to be the end of the world, or sink the economy. it will impact different people in different ways.
Absolutely. Yep. Great question. All right. It looks like our last one, at least what's on the screen here, is that the federal government appears as if it will not reduce spending anytime soon. Is this spending limitless, and how will this affect the economy over the short, long term if government spending continues as it has? Great question.
Yes.
Yeah.
You want to try that first?
I'll begin with that one. Yeah. So it seems as though the presidents are learning from one another and not learning in a good way. So this began with George W. Bush had to do a fair amount of spending with the Iraq War. Our federal deficit ballooned at that time. Some of you on the line may think that was justified, others may not. I'm not here to give an opinion about that. But we ballooned federal deficit at that time. If you remember right at the end of the George W. Bush era, the subprime lending crisis had occurred. George W. Bush put the first QE program into place, and then, the first bailout, and then QE started after that under the Obama administration, under which spending again, or deficits again ballooned. And then we ended up in the Trump era, and the Tax Cuts and Jobs Act again ballooned it. And now at the end of the Trump era into the Biden era, we are getting these different stimulus bills. So whether you think they're justified or not, I'll leave that up to each of you. However, what I would say is there has been a multi-president, multi-political party, 2 presidents Republican, 2 presidents Democrat, that have now been spending what I call like drunken sailors. Maybe that's inappropriate, my apologies. But it's a great question. The answer to the question is yes, this will be a long-term problem for the United States if it is not addressed in some way, shape, or form. Now, I want to be cautious here, because some people will read into that comment and think, oh, that's what I thought, I need to jump ship. We would say, as we have studied other economies around the world and where kind of like how rising debt to GDP levels impacts their economy, we actually think the presidents know something that maybe all the consumers do not, which is actually quite a bit of room for them to raise federal deficits without, as long as they keep interest rates low, by the way. They can raise federal deficits while keeping interest rates low. You can still have a thriving economy and thriving corporations within that set. It does eventually reach a level at which it becomes overly painful and overly problematic. And that starts to get into issues around currency problems and things like that. But I would argue we're actually quite a ways away from that yet, based on the research and study that we've done.
So
what do you think?
This debt and deficits question was a big topic about a decade back, about in 2012, because if you'll recall, in the world at that time, they called them the pigs, right? Portugal,
Yep.
Ireland, Greece, Italy, Spain. There's these European countries that had huge debt to GDP ratios, I think 150, 170%. Right. And I actually had attended back then a luncheon back when I lived in Southern California, and the speaker there was this gentleman named Josh Bolton. He'd been a bigwig at Blackstone, which is a large private equity firm, and he actually worked in the Bush administration as a policymaker. And he was interesting to listen to because he was very pragmatic about the crisis, right? He's certainly one of those people. I don't think he, even though he worked in an administration, had a particular party line view on it. He almost had dedicated his life to this sort of debt and deficits idea. And he said, look, it's going to be painful, almost what you said with 2 presidencies that have gone through, CJ, in the spending. I don't think either political party, in my opinion, is going to fix it. There's just no traction to, as he explained at this luncheon, to really make a dent in the spending. It requires going after things that are truly, he called them sacred cows to each political party, that just is so unpopular to touch as a politician. So I think, CJ, you are right in that there is probably room to run a little bit, right? We're at probably 120%, and that number can probably go up another 10 or 15% and be okay if interest rates are low and the economy is growing. I think where it becomes a potential problem is if it gets really out of hand, like you saw with those European countries, and you run into issues of your currency. What would it mean for us in the future? I think it's one of the reasons why we invest globally. We don't put all of our eggs in the basket of the United States. There are people out there that this is a great country we live in, greatest in the world, but it doesn't mean that we need to have all of the investment instruments that you own tied only to this country. And I think that's a big part of how I would think about that conundrum.
I think Todd hit the nail on the head. So to wrap up here, there's this concept in investing called home country bias. And if you look at a portfolio of somebody who lives in Canada, as an example, surprise, surprise, the majority of their equities will be in Canadian equities. An American will be in American equities. And so one thing that we are very cognizant of is changing environments around debt levels, around society, around GDP globally. And so part of the reason we invest globally is we don't want all your eggs in one basket, not only from the standpoint of the basket of, say, just a stock or just a bond, but also geographically. And so as that environment changes, if the United States risk level starts to become more of a burden on debt level becomes more of a burden on US corporations, that gives us the opportunity to invest globally. But I would echo everything Todd had said and add on to it as it relates to the amount of room we have to run. The PIGS, as they were called, Portugal, Italy, Greece, Ireland, Spain, they were not the they were not the world's currency. Yes. Or the largest economies in the world. They didn't have tools in the toolbox that the United States does. So we may actually, believe it or not, have room to go up to 180 to 200% debt to GDP before we would feel the pain points of the smaller economies. I just want you all to know, I don't like it any more than you do. To me, it's irresponsible, and it's something that needs to be addressed by a president. But to Todd's point, it's highly unpopular, and it might be hard for any said president to get reelected.
And I want to say the last time someone really ran on that campaign as like their premise, I think was 1992, and it was Ross Perot.
Yeah.
And so you saw how far he got.
That's right.
So,
yep. It looks like we did have one more pop up. We'll try to take this quick and then wrap up for the day. But it says, so if no appetite to curb spending, does that leave politicians
raising taxes?
Raising taxes. What are your thoughts?
What's more unpopular? And I guess it depends on the party. Raising taxes or cutting Social Security. I mean, I don't want to create hysteria, but it's either the solution to the debt going down is either to tax more, bring in more income, or spend less, which comes down to paying out less in benefits, and that's very unpopular. So is the tax side of it, but things like military pensions and things like there's all these areas. I don't know which one it will be, and it will probably depend on the party. But as we showed with that graph, one of them will have to budge eventually.
Yes. Well, and what we would say is both the brilliance and maybe potentially the poison here as we move forward to the United States is that the pendulum continues to swing from party to party. And so the way in which one political party chooses to address it versus the other can swing, and therefore it can be hard to determine what will the long-term solution of this be.
And I think to CJ's point, though, that just because the Trump administration was in office for 4 years, and you think, oh, Republicans, well, they're going to do this to it,
right?
But neither party might do nothing about it, and that could go on for actually decades or more before it sort of reaches that crisis inflection.
Right.
So we will see.
Yeah. But the questions are great. The question about could that mean rising taxes? I guess I want to address it directly and answer that question. Of course, that's what it could mean. We're not saying it will, and at what level and for how long and with what consistency, we don't know. But there's no doubt that there could be an incentive to raise taxes relative to the amount of debt that we have. So a lot of unknowns. I know that unfortunately we're not giving you a perfect view into what the future will hold, but as we said, we want to separate fact from fear here during these discussions, that we want to give you the information that we know and let you know kind of how we're addressing it inside of both financial planning and portfolio management. Any other closing thoughts?
No, thanks for tuning in, everyone.
Yeah, thanks everybody. Appreciate you joining. We will do another one in another quarter from today. And as we mentioned, this will be posted to our website in about a week or so. So feel free to jump on there. Great seeing you all.
Thanks, everyone.
Bye-bye.